Madam Secretary, if you could begin.
Thank you, Senator Toomey. Chairman Brown, Ranking Member Toomey, members of the committee, thank you for inviting me. We're meeting at a hopeful moment for the economy, but still a daunting one. While we're seeing signs of recovery, we should be clear-eyed about the hole we're digging out of.
Figure it out in order.
The country is still down nearly 10 million jobs from its pre-pandemic peak. When Congress passed the CARES and Consolidated Appropriations Acts last year, it gave the federal government some powerful tools to address the crisis. But upon taking office, I worried they weren't powerful enough. After all, there were and still are some very deep pockets of pain in the data. 1 in 10 homeowners with a mortgage are behind on their payments, and almost 1 in 5 renters are behind on their rent. There are 22 million people who say they don't have enough food to eat. 1 in 10 adults are hungry in America. I looked at data like these and I worried that the COVID economy was going to keep hurting millions of people now and haunt them long after the health emergency was over. We know that when the foundations of someone's life fall apart, when they lose the roof over their head or the ability to eat dinner every night, the pain can weigh on them for years. Their earnings potential is permanently lowered. I worried about this happening on a mass scale. That's why I advocated very hard for the American Rescue Plan. And it's why my first and most enthusiastic message today is thank you. With the passage of the rescue plan, I'm confident that people will reach the other side of this pandemic with the foundations of their lives intact. And I believe they will be met there by a growing economy. In fact, I think we may see a return to full employment next year. Of course, the speed and strength of our recovery depends in part on how we implement the legislation. Treasury is tasked with much of that work, and there's nothing that I or my team take more seriously. We appreciate your oversight on this matter, and I want to briefly tell you about how we have been working. Since taking office 2 months ago, we have been expediting relief to the areas of greatest need. For example, small businesses, and especially the smallest small businesses, which are disproportionately owned by women and people of color. The pandemic has hit these businesses hard. The Paycheck Protection Program was an early lifeline, but because of issues with the program's design, the first rounds often didn't reach the smallest sole proprietorships. We're addressing that now. We worked with SBA to tweak how the program was implemented. It's allowing the PPP to reach millions more micro businesses and entrepreneurs, especially in rural and low-income areas. We're also building capacity to support these communities over the longer term. Because of the December legislation, Treasury now has $12 billion to inject into community development financial institutions and minority depository institutions. In turn, these CDFIs and MDIs can lend that capital out, helping people buy homes and start businesses in places that the financial services sector traditionally hasn't served well. Then there are the families I spoke about, the ones struggling to keep a roof over their head and food on the table. The American Rescue Plan provides more than $30 billion to help renters and homeowners at risk of losing their homes. And we're making sure that assistance flows as efficiently as possible. For instance, the previous administration put in place rules that required tenants and landlords to provide quite a bit of documentation to get rental assistance, including detailed statements about their income. But some people don't have access to those documents. We're cutting through the red tape for them while still taking reasonable steps to prevent fraud and abuse. And of course, we've been sending direct payments to Americans, a lot of Americans. As of last week, we had issued over 90 million payments. And all this is just a fraction of Treasury's work. There are so many more relief programs, including one that will provide $350 billion in aid to state and local governments. Implementing all of it is more complicated than it sounds, and we're working closely with stakeholders to make sure that these programs are both efficient and effective. Behind these many relief programs, these millions of transactions, are a staff of very dedicated and very tired Treasury and IRS employees. My final word is to them. Thank you. You're putting on a master class in how government should work in the furnace of a crisis. I'm grateful to be your colleague. With that, I'm happy to answer any questions you have.
Thank you, Secretary Yellen. Chair Powell, you're recognized for 5 minutes. And thank you, Ranking Member Toomey.
Chairman Brown, Ranking Member Toomey, and other members of the committee, thank you for the opportunity to discuss the measures that we've taken to address the hardship wrought by the pandemic. I'd like to start by noting the upcoming one-year anniversary of the CARES Act. With unanimous approval, Congress provided by far the fastest and largest response to any post-war economic downturn, offering fiscal support for households, businesses, healthcare providers, and state and local governments. This historically important legislation provided critical support in our nation's hour of need. As the virus arrived in force, our immediate challenge was to limit the severity and duration of the fallout to avoid longer-run damage. At the Fed, we also acted with unprecedented speed and force, using the full range of policy tools at our disposal. Today, the situation is much improved. While the economic fallout has been real and widespread, the worst was avoided by swift and vigorous action from Congress and the Federal Reserve, from across government and cities and towns, and from individuals, communities, and the private sector. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved. But the recovery is far from complete. So at the Fed, we will continue to provide the economy the support that it needs for as long as it takes. As we've emphasized throughout the pandemic, the path of the economy continues to depend on the course of the virus. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued social distancing and mask wearing will help us reach that goal. Indicators of economic activity and employment have turned up recently. Household spending on goods has risen notably so far this year, although spending on services remains low, especially in sectors that typically require in-person gatherings. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. As with overall economic activity, conditions in the labor market have recently improved. Employment rose by 379,000 in February, as the leisure and hospitality sector recouped about 2/3 of the jobs that it had lost in December and January. The recovery has progressed more quickly than generally expected and looks to be strengthening. This is due in significant part to the unprecedented fiscal and monetary policy actions I mentioned, which provide essential support to households, businesses, and communities. However, the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak, and the unemployment rate, still elevated at 6.2%, underestimates the shortfall, particularly as labor force participation remains notably below pre-pandemic levels. We welcome this progress, but we will not lose sight of the millions of Americans who are still hurting, including lower wage workers in the services sector, African Americans, Hispanics, and other minority groups that have been especially hard hit. The Fed's response has been guided by our mandate to promote maximum employment and price stability for the American people, along with our responsibilities to promote the stability of the financial system. When financial markets came under intense pressure last year, we took broad and forceful actions, deploying both our conventional and emergency lending tools to more directly support the flow of credit. Our actions taken together helped unlock more than $2 trillion in funding to support businesses, large and small, nonprofits, and state and local governments between April and December. This support, in turn, has helped organizations from shuttering and put employers in both a better position to keep workers on and to hire them back as the recovery continues. Our programs served as a backstop to key credit markets and helped restore the flow of credit from private lenders through normal channels. We deployed these lending powers to an unprecedented extent last year. Our emergency lending powers require the approval of the Treasury and are available only in very unusual circumstances. Many of these programs were supported by funding from the CARES Act. Those facilities provided essential support through a very difficult year. They are now closed, and the Fed has returned the large majority of Treasury's CARE Act equity as required by law. Our other emergency lending facilities are following suit imminently, although we recently extended the Paycheck Protection Program lending facility for another quarter to continue to support the PPP. Everything the Fed does is in service to our public mission. We're committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible on behalf of communities, families, and businesses across the country. Thank you. I look forward to your questions.
Thank you, Chair Powell, and thank you, Madam Secretary. Chair Powell, do you think all this fiscal support will help us get to full employment and improve our overall economic and GDP growth?
I think that the fiscal support that Congress has provided since the beginning has been really at the heart of the recovery and deserves much of the credit for the strength of the recovery over the course of the last year. I'm loath to comment on particular fiscal bills, as you know, but I would just say generally this situation really called for a strong fiscal response, and we've certainly had that.
Thank you. Secretary Yellen, how does the American Rescue Plan help women and people of color and the workers who've so often been left behind in our economy?
Well, the rescue plan is very much focused on getting aid in a whole variety of ways to those groups, starting with unemployment insurance, rental assistance for people who are in danger of losing their homes, food assistance, assistance to small businesses, especially in low-income minority communities, just aid to state and local governments, much of which can be directed toward those groups that have been most adversely affected by the pandemic. So there's also child support, an increase in the child tax credit to help families with burdens, household burdens. There's an expansion of the child independent care credit that will help women who are at home with family responsibilities get back to work. So a broad range of features that are directed at those groups.
Thank you, Madam Secretary. And I noticed one of the first things you mentioned is particularly of interest in this committee, and that is the work that a number of my colleagues did to help renters pay their bills and keep roofs over their heads, a roof over their head. I hope you'll continue to work with state, local, and tribal grantees to help this out, to get this help out to renters quickly. Secretary Yellen, do you think people are getting, thank you, do you think getting people vaccinated as fast as possible, as the Biden administration, as the American Rescue Plan are doing, does getting people vaccinated as fast as possible, does that help the economic recovery?
Oh, yes, absolutely. As Chair Powell indicated in his own remarks, ultimately the economic recovery depends on success in getting the pandemic under control, and vaccinations are critical to our ability to accomplish that.
And Chair Powell, as you had said earlier, you obviously agree with Secretary Yellen on that from what you said earlier. Do you think, Chair Powell, do you think direct payments to families help the economic recovery?
Again, I'm reluctant to, these matters are for Congress, not for elected representatives, not for us. Nobody has elected us to make those decisions. I would just rather say at a high level, I think fiscal policy has provided a lot of support, and that's been appropriate.
Secretary Yellen, do you want to expand on that same question briefly, direct payments helping the economic recovery?
Well, I think the direct payments are providing support to families for a wide range of burdens that many have suffered over the last years. There's other support that's clearly targeted, but I think this is helpful in the spending that it will produce will speed the recovery.
One last question to both of you. Secretary Yellen, do you think that banks buying back their stock helps the economic recovery?
I have been opposed earlier when we were very concerned about the situation that banks would face about stock buybacks, but the financial institutions look healthier now, and I believe they should have some ability to, abiding by the rules to make returns to shareholders.
Okay, my last, even though I said that was the last, my last joint question to both of you, to each of you. What are the lessons learned from the pandemic's impact on the economy that we should use to make the economy and financial system more resilient to the impacts of climate change? Do you want to start, Chair Powell, on that, and then close with Secretary Yellen?
So on climate change, I'll just quickly say that we have a mandate to supervise financial institutions and one to look after financial stability. So we don't have a mandate to do anything in particular regarding climate change. We look at it as only to the extent it's within those particular existing mandates. And as you know, we are in the early stages of trying to understand what the implications are for both for financial stability and for on a microprudential basis for individual financial institutions. How should they think about those risks and ultimately manage them over a longer period of time?
Now, Secretary Yellen.
Yeah, I agree with that. I think it's very important to make sure that financial institutions are resilient to the risks from climate change as well as other risks. And I think it's important for regulators to assess those risks, both to understand them and to help the institutions themselves understand and manage their risks.
Thank you, Madam Secretary. Ranking Member Toomey is recognized.
Thank you, Mr. Chairman. I just have to observe, if you pick up almost any newspaper in towns across Pennsylvania in the last week or so, a prominent story has been recurring all across the state. That is the story of mayors and township commissioners and county commissioners meeting to try to figure out what in the world they're going to do with this mountain of cash that just got dropped on them after having collected all the revenue they expected last year. In some cases, it's 50% of their entire budget. Really, just extraordinary. My question, I'll start with Chairman Powell. And what I'd like to do, Mr. Chairman, is follow up on the conversation we had last week. I want to kind of understand how the recent Fed projections fit together, because in some ways there are some apparent outliers, at least it appears that way to me. What I'm referring to is, the Fed's recent revisions, economic forecasting revisions, have a very significant upward revision in GDP growth. 6.5%, I think, is your real GDP number for this year. Not inconsistent with where a lot of private economists are, but that's a 2.3 percentage point increase. The unemployment rate that you project is only a decline of 0.5%. And the inflation rate, over the course of the full year, you guys are projecting that it will come in lower than it's been for the last 3 months. So on average, for the remainder of the year, you're implicitly projecting inflation to decline. So I think most economic models that would have that big an upward revision in economic growth would have a stronger reduction in unemployment and higher likelihood of inflation. And my concern is if your models systemically were to understate the progress we're likely to make on employment and understate the risk of inflation, of course, it could lead to accommodative policy that goes too far for too long. So can you walk us through why you have a relatively small improvement in the unemployment rate and a declining inflation despite the strong GDP growth?
I'd be glad to. Let me start by saying that what we publish in the Summary of Economic Projections is just that. It's individual projections that are totaled up and tabulated, really, it's not something we vote on, but I'll address the medians, which are what we publish. So the reason that unemployment doesn't go down further, given the level of growth, is really just that we see participation expanding on it's a different margin. It's people coming back into the labor market, and that actually holds the unemployment rate up. Is a highly desirable outcome. But this was the biggest drop in participation since World War II. That's part of it. There are a bunch of other things that go into it, and of course, there's a good amount of uncertainty around that. On inflation, go ahead.
I'm just, my concern is because obviously private sector economists are aware of the decline in the workforce participation and seem to come to different conclusions. But I understand this is an art, not a science. Let me just, I'm going to run out of time here, direct my next question to Secretary Yellen. But first, on the topic of IMF SDRs, I do want to thank Senator Kennedy for his leadership on this issue. Madam Secretary, as you know from our conversation, I'm very concerned about the issuance of another $500, $600 billion of SDRs in the name of helping poor countries respond to COVID. SDR allocations are not meant to be a source of foreign aid. That's the realm of Congress to decide whether or not to extend foreign aid. And as you yourself have pointed out, this is an extremely inefficient way to deliver that aid, since the money goes mostly to G20 countries that have no need for this. So I'm just wondering why it is that you seem to have changed your position on the desirability of using SDRs for this purpose. And is this a final decision that's already been made, or is it still in flux?
Well, before committing to it, we will certainly, as the law requires, consult with Congress. I would say that the current crisis has increased the need for global reserves, and that's the IMF's assessment. The global economy suffered a very severe collapse in 2020. It contracted by 3.5%. The emerging market and developing economies face considerable external financing needs, and an SDR allocation will help countries meet this need for reserves without forcing them to tighten fiscal policy, which could lead to further global divergence. Now, this is a joint effort of the global community, and there's broad support for an SDR allocation. It's true that rich countries will get SDR. That's how it works. It's tied to each country's quota in the IMF. But many countries have indicated a willingness and desire to recycle the SDRs they receive, either in the form of loans or grants, to low-income countries. And so that will magnify the impact of the SDR allocation in terms of providing resources to low-income countries.
I see I'm out of time. Thank you, Mr. Chairman.
Thank you, sir. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. Welcome, Madam Secretary. Good to see you.
See you, Tip.
We are all interested in getting everyone back to work. You've indicated, though, recently that it could be a full year until we reach full employment. In that interim, would you support enhanced unemployment benefits? I think the American Rescue Plan has done a great deal to help the unemployed, but that effort, I think, should continue. Your views, please.
Well, I think, unemployment remains high, and it's important to provide the supplementary relief in the ARP. And that begins to expire, I believe, in the fall, when I believe the economy will be getting back on its feet. People have raised concerns about whether or not this additional aid will deter people from going back to work. That's certainly not an issue